Ira Epstein of Linn Associates with your agriculture update for this Monday, the 24th of June, 2019, getting on to 3:45 p.m. Central Daylight Time. So we just saw the crop conditions, and as you can imagine, they're poor. We're looking still at way behind on plantings in soybeans. The emergence is normally in the 90 percentile. We're at 71%. And remember, soybeans, unlike other plants, they stop getting a certain amount of sunlight during the year and they stop growing. So it's a very interesting time there. The stock market, they tried breaking it a bunch of times during the day, but it has managed to hold on very well. Dollar index down a little bit at the expense of a number of currencies, just drifting sideways. We have the G20 meeting coming up. That's what the market's really going to look for. The market wants to see, how does the U.S. and China really do? I'm not talking the words where the two presidents are shaking hands. The real question is, do the negotiations pick back up with what the U.S. thought had been agreed to, or does the U.S. really walk away from the table? There's going to be a certain amount of face saving here. There's going to be a certain amount of we don't get the truth. So you got to read through the lines to figure out what's going to go on. But what's been going on is a run in the upside in the soybean market and in the corn market. And the run is based on weather. Weather has been unbelievably wet. It hasn't been hot yet, and that wet weather is setting everything back from, let's say, growth, in the case of corn, to in the soybeans not getting the rest of the crop. And we estimate there's about 12.5 million acres of soybeans that are still not planted. And given that you had in many states already the date come where each day that you plant after that, your insurance drops by a percentage point. If I'm in a wet field, I'm taking my insurance and I'm running. And I realize the market goes higher, the farmer's going to say, yeah, but I even with less yield, I get more acreage. Okay. But in looking at the market here, you are up to 909, and that's a pretty good close on, at the end of it. So for the week, we're up 6 1/4 so far. You can see how the market, as it's had gaps in these two areas, it's filled them. We're drifting sort of sideways right here now. In terms of a trend, let me explain it. Yes, I know you can look at this as the overall trend is up. That doesn't take any real skill. You have higher lows. That's bullish. You had higher highs, and now you've lost that higher high pattern. So what we've gone into is a market that's got a down slope in terms of lower highs, and it has an upslope in terms of higher lows. You're in a pause pattern right now. Whether it comes out of that easily tomorrow, I don't know. Should the market take out 922 and not take out 942 3/4, you could be in a corrective mode. That mode could carry the market back to the 100-day average and the 18-day average of closes. Should the market decide to go up at any point, the Bollinger top is waiting for the market at 950.5. Many traders, and I go on the trading floor, I was there today, are still talking beans easily at $10, corn $5 numbers. Well, don't know, but that's what the trade talk on the floor that I'm talking to the traders, and I walk right into the bits. So that's what they seem to be thinking. As you take a look at the slow stochastic study on the beans, it is not embedded. Market's got a 79 number. Now let's go back and look at this. You can see that on Friday, you didn't have both numbers over 80. They were over 80 on Thursday. Both numbers were over 80 on Wednesday, and they were over 80 on Tuesday. So we had an embedded reading. Now the market has lost that. So even with these numbers that are coming out, the odds favor, now that you're 2 days out of losing the embedded reading, that price and the run at these 18 and 100-day average could easily be underway. In the meal market, it's similar to beans. You've got the higher lows, but you've got the lower high that is set in at the same time. The bias is down because the market is trading on a settlement basis underneath the 18-day average of closes, putting into play the potential, that's all it is, to get down to 312, 312 3/4, 312.60 actually, or if the market clears up here 324.70 to make a run potentially to the upper Bollinger Band. I'll call it a stall right now. Soybean oil is still in an uptrend. Still has the pattern of higher lows, higher highs, resistance, the upper Bollinger Band at 28.83. Momentum is overbought. It is not an embedded. Remember, embedded takes place when the two numbers that make up the slow stochastic are going either sideways over 80 or sideways under 20. It takes at least several days in a row of doing that for me to say the market's left the overbought status and it changed its course and it's locked in an uptrend, and it stays that way until the red line closes back under 80. You're not there though. In the corn market, it's the same type of pattern. We have a stall today. Maybe everybody wanted to see, from the looks of it, just what the planting conditions look like. In other words, how's the crop doing? The emergence numbers, where are we looking at that? What states are behind? And I can tell you in corn, the big states, Illinois, Indiana, Iowa, Michigan, we're all behind, way behind. So while you might get what we call those smaller fringe states that are doing well, the big boy states have a real problem. You have lower highs, higher lows. I'm going to call it a stall again. Will the market go back to the 18-day average to try to figure out what to do? Don't know, but that's a logical support zone. If you look at momentum, this market is working off being overbought. As long as either of these numbers are over 70, I consider them overbought. When they get over 80, they've got to stay sideways for several days, or under 20, stay that way for several days to have the word embedded. This is just overbought, oversold. Wheat's always the wild child in the grains, and it acted beautifully today in the sense of an outside day up. Higher lows, higher highs, resistance back here. Let's call that the the 550 level. And if we break today's lows, you'll hurt this pattern bad over Tuesday and Wednesday. So the key is not to take it out either of those days. This is a market that had worked or was working on getting itself out of overbought. It is still overbought. The numbers are not over 80, they're just over 70. It's overbought. In the sugar, at this moment, we have a downtrend. We can see that the market has failed at the 100-day average on numerous attempts. You've got lower highs, lower lows. Bearish. Momentum pointing down. The reading is not under 30. Any reading under 30 is oversold. If the market extends, maybe 1227 is the number that you go to, the lower Bollinger Band. To negate the downtrend, the market has to take out this high of 1276. So I view the market as having the bears in control, momentum down, resistance 1267. You don't want to see it over 1276 if you're going to keep the pattern of lower highs, lower lows, momentum down. In the coffee market, an outside day up. So what the market did, and I think we can all see this, you had a downtrend, didn't quite extend to the lower Bollinger Band, had a rally on last Thursday that carried into the 100-day average in the 18. You still had the trend down, lower highs and lower lows. The market then rallied up and over this number. So now you're out of your downtrend, and with today's action, I can call the market saying higher lows, higher highs, uptrend. Market closed over the 18-day average of close. That defines bias as being up. Momentum up. So until today's low is taken out, I think the bulls grab control of the market. A target could be, doesn't have to be, but it could be the upper Bollinger Band near that 112 area. In the cocoa market, we have a market that is staying over the 18-day average of closes, so the bias is up. The pattern has been one of lower highs and lower lows, so the trend is down. When bias is up, trend is down, you have nothing. They negate each other. And if you look at this market, you're in overbought condition. So if the bears want to grab control, they have to start pushing the market back down under that 18-day average of closes and keep it there. If the bulls want to negate the downtrend, they got to get this market up and over this 25, I think it was, let's get the exact high, 2537 level. And those are the numbers that I see in play. In the cotton, I'm still in the bear camp. I still overall see a market that's having great difficulty in staying over the 18-day average of closes. It gives me the bearish bias. I look at momentum. Momentum is not turned up, still down. Now, if this market takes out today's low tomorrow. What you end up with are lower highs, then a lower low. In fact, the ideal number to take out is 65.52, and today's low is 65.57. So let's give it to that. Take it out, hit 65.51, and you'd have the lower highs, lower lows. Then the question is, can you get down to the 100-day up to the lower Bollinger Band? Boy, I'm confused there. 64.69, or do you fight a battle right here at the 18-day average? The 100-day, and that's what my brain was looking at, and I don't know why, is 72.35. So I still see a downtrend. In the cattle market, we had a bearish cattle on feed report. The market, as you can see, went down, challenged the lower Bollinger Band, where I'd expect to see the pros take some money off the table. That's what happened. You're oversold in a downtrend. You've hit some downside targets, and you did the same thing today in the feeders. If you look at the feeder cattle low on Friday, the market had a low of 132.42.5. Just missed that lower Bollinger Band. You went and hit it today, and for all purposes, the market sort of stalled out. The bigger picture is, as long as the market stays under the 18-day average of closes, you have a bearish bias, downside momentum that is now oversold and has hit some targets. That doesn't mean you can't go lower, but the market's worked itself off. In the hogs, the cold storage report did the market in. If you looked at the amount of pork in storage, pork bellies, I mean, it's just monstrous everywhere, and this market keeps falling apart, and there's nothing yet to say this market's going to do anything. A lot of traders are talking the 70 level is what the market has to get to find a value. I don't know. I know it's oversold under the lower Bollinger Band. The patterns are higher high and lower low, so it's difficult. Let's talk about trading. And, you know, Modern Trader magazine has these technical trading tips for the top pros. Now, I worked with this magazine a long time ago. I think they're finally finding somebody to reorganize them, and I love the magazine. But with their permission, we had gotten their PDFs. Actually, we helped them create them again, and we've put this all together for you so that you can see some of these fantastic articles that are as good today as they were, in my opinion, the day they were written. How do you optimize stops? Why does that change? Moving averages, they don't change. How do you get a copy? It's real simple. We send it to you as a PDF. Just give us a call. Go to our website. You'll see our free offerings. Click on what you want there. All of this, by the way, is in our futures trading kit. You can click up here if you'd like to get a copy of that if you're watching me on YouTube as well. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.